Welcome to our discussion. There is this very specific, very modern dread that hits right around the time you check your mail here in Colorado.
Oh, yeah. Looking for that property insurance renewal.
Exactly. You just stand there at the mailbox holding the envelope, and you're basically, bracing yourself for absolute sticker shock before you even tear it open.
Right. I mean, it has easily become the most anxiety-inducing piece of mail for property owners in the state right now.
Oh, totally.
The numbers people are seeing on those renewal pages, they just do not even feel real sometimes.
But, if you've opened one recently or if you're about to, there is actually a silver lining hiding in that envelope.
Yes, there is.
Because a brand new, report card of sorts is now legally required to be attached to that bill.
And honestly, that report card represents arguably the single most important document a property owner in Colorado can hold right now.
Really, the most important.
Absolutely.
Yeah.
Because it completely changes the power dynamic between you and the insurance company.
Well, that is exactly what we were getting into today. In this discussion, we are unpacking the massive upheaval in Colorado's property insurance market.
There's a lot to unpack, definitely.
Yeah, we're going to figure out exactly why those premiums are skyrocketing in the first place, how these new state transparency laws finally empower you to fight back, and what totally new state programs are being built for 2027 to fix the actual structures we live in.
Because, frankly, understanding the mechanics of this market is it's no longer optional for homeowners.
No, it's really not.
The fundamental rules of how your home is evaluated have shifted entirely underneath your feet.
And just to be clear on where our information is coming from today, the facts we're exploring are drawn strictly from government sources.
Right, which is so important.
Yeah, we are looking at data and reports from the Colorado Division of Insurance, the DOI, the Division of Real Estate, the Colorado General Assembly, along with some grounded practical insights from the insurance providers themselves.
Relying on those specific regulatory sources is vital right now.
Yeah.
I mean, there's just an immense amount of neighborhood rumor and, well, misinformation circulating about what insurers are legally allowed to do.
Right.
And more importantly, what rights the homeowner actually has.
So before we figure out how you can actively fix your insurance bill, we really have to look at the macro forces making it so expensive.
Let's do it.
I was looking through the actuarial data provided to the DOI, and I mean, the numbers are just brutal. For certain types of properties like HOAs and the lodging, premiums haven't just gone up a little, they've more than doubled.
Yeah, and when people see a premium double, the immediate assumption is that the insurance company just changed the rate to make more money.
I mean, that's what I would assume.
Sure, it's natural. But when you look at the actuarial data, the underlying mathematics of the physical properties have actually changed.
How so?
Well, it's inflation, it's stricter underwriting, but the most massive driver is a metric called total insured value, or TIV.
Total insured value. Right, I saw some numbers on that, and it frankly blew my mind.
It's wild, isn't it?
It is. There is an urban ZIP code in Denver where the TIV went up over 9,000%.
Yeah. 9,000.
How does a neighborhood's insured value spike by 9,000% unless they, suddenly pave the streets with gold?
You really have to break down what total insured value actually represents.
Yeah.
It is not what your house would sell for on the real estate market.
Okay.
It is the absolute maximum dollar amount the insurance company would have to pay out to clear the debris and rebuild every single structure in that area from scratch on the worst day imaginable.
Oh, wow. So it's the cost of lumber, the cost of specialized labor, copper wiring, concrete.
Think about a subdivision built in, say, 1995. Back then, it was basic materials, unfinished basements, standard roofs.
Right.
Fast forward to today, those same homes have finished basements, luxury kitchens, solar panels.
Oh, I see.
And the cost of the raw materials and the contractors to rebuild them has inflated astronomically. So the physical footprint is the exact same, but the pure financial exposure sitting in that one concentrated geographic area has expanded massively.
Okay, that makes sense. The target hasn't necessarily grown in physical size, but it's grown in density and dollar value.
Precisely.
So what are the actual threats targeting these properties? Because given all the news coverage over the last few years, I would have bet my life savings that wildfire was the #1 risk factor driving this.
Most people would.
But the data ranks hail as the absolute top cost driver.
Right.
Then risk appetite, and then finally, wildfires.
Yeah, hail is incredibly destructive and More importantly, it is frequent.
Right.
Wildfires are catastrophic when they happen, absolutely,
Yeah.
but they are isolated. Hailstorms sweep across the Front Range constantly.
Yeah, they really do.
When a storm hits a large campus-style HOA property with massive, complex roof surfaces, the insurance company isn't just replacing one roof. They're replacing 30 massive roofs all at once,
And doing it at today's inflated labor and material costs.
which just devastates their loss ratios. But you also mentioned risk appetite.
Yeah, what exactly is that?
That's the insurance term for how much unpredictability a company is willing to stomach. Because they've taken such massive losses from severe weather events east of the Rockies over the last few years, their appetite for gambling on unpredictable weather has basically vanished.
That explains the broad trends for sure. But looking at granular ZIP code data, the pain is highly regional.
Very much so.
Like in mountain resort towns like Breckenridge and Steamboat Springs, the data shows premium increases anywhere from 133% to 205%.
Yeah, and those specific areas represent a worst-case scenario for an underwriter. You have incredibly high wildfire risk combined with a dense concentration of highly custom luxury properties.
Properties that would cost millions upon millions to rebuild.
Exactly. It's high probability of loss multiplied by massive total insured value.
But then you look at Front Range gateway nodes, places like Estes Park, and there is a totally different mechanism driving the cost.
All right, Estes Park is a great example.
They are seeing huge increases, but it's not just the direct threat of a wall of fire burning a building down. It's smoke-related business interruption.
The mechanics of business interruption are fascinating, honestly, and they show how interconnected this risk really is. A fire doesn't even have to come within 5 miles of a hotel to trigger a multi-million-dollar claim.
Because of the wind, right. The fire is miles away, but the wind blows the wrong direction, and suddenly the hotel is engulfed in a thick cloud of smoke.
Yeah, and commercial HVAC systems pull that particulate matter directly into the building. The smoke permeates the carpets, the curtains, the bedding. It becomes a severe health hazard.
So they have to close down.
They're forced to shut down, cancel a month's worth of reservations right during peak tourist season, and pay for massive industrial remediation.
And their business interruption insurance has to cover all that lost revenue and cleanup cost, even though not a single flame touched the physical property.
The claim is just as expensive as if the lobby had actually caught on fire.
Hold on, though. I hear these massive numbers, the 200% increases, the 9,000% TIV spikes, and I have to ask the question every homeowner is thinking right now.
Well, for it.
Is this actual mathematical risk? Or is this just insurers taking advantage of the climate change narrative to artificially pad their margins while leaving homeowners stranded?
It's a fair question.
I mean, it feels like a brutal game of musical chairs where the carriers are just pulling out and taking their chairs with them.
It is entirely valid to question the motives when your bill doubles. But when you look at the raw financial filings, insurers have lost billions of dollars.
Billions.
Billions. They aren't padding margins. In many of the ZIP codes, they were paying out far more than they were collecting. The old mathematical models they used to calculate risk, they just fundamentally broke down.
But how does an entire industry's math just break?
Well, in the past, underwriting was broad. An insurer might look at an entire county or a really wide ZIP code and assign a general risk rate. Everyone paid into the pot.
Okay, so it's like going to dinner with 10 friends and just splitting the bill evenly at the end of the night. Like, I ordered a side salad and a water, but I'm paying an equal share for the guy who ordered the steak and lobster.
That is a perfect analogy. For decades, the homeowner in the middle of a dense pine forest was eating the steak and lobster, and the homeowner in the paved suburbs was ordering the salad.
And the suburbanite was unknowingly subsidizing the risk of the forest home.
Exactly. But now, because of massive losses, insurers have adopted hyper-local, property-level risk models. They use satellite imagery, topography mapping, and AI vegetation analysis to pinpoint the risk down to your specific address.
So the waiter is suddenly handing everyone separate checks.
Yep. And the guy in the forest is looking at a massive bill and panicking, while the suburbanite is no longer subsidizing him.
Wow.
If you live in the wildland-urban interface, the algorithm is now forcing you to bear the true, unsubsidized mathematical cost of your specific property's risk.
So if the risk modeling has become this incredibly granular and, well, intense, how is the state stepping in? A lot of people were hoping the state would just put an artificial cap on rates, but that's not what they did.
No, because capping rates artificially usually just causes insurance companies to leave the state entirely, which creates an even worse crisis.
Right. Then nobody has insurance.
Exactly. Instead, the Colorado General Assembly and the DOI focused on transparency. They are forcing the insurers to open up the black box of their algorithms.
Which brings us back to that silver lining in the envelope we talked about. The state passed House Bill 251182, and the DOI issued Bulletin B 5.56. How do these actually force transparency?
So, under this legislation, insurers are now legally required to provide a plain language annual written notice to policyholders and applicants.
Plain language.
The phrase plain language is mandated. They can't bury this in actuarial jargon on page 40 of your policy.
So what specifically is on this report card?
3 crucial things. First, it must reveal your property's exact wildfire risk score.
Oh.
Second, it has to show you the range of possible scores for that specific model. So you get an 84, you actually know if the scale goes to 100 or 1,000.
Oh, that's huge. Context matters.
And third, and most importantly, it has to explicitly list the primary physical features of your property that drove that score up or down.
I always think of this like a credit score. For years, dealing with property insurance felt like applying for a mortgage, getting denied for having a terrible credit score, but the bank absolutely refuses to show you your credit report.
Yes, you were completely flying
You
blind.
just have to wander around guessing what you did wrong.
Right. You might cut down 3 trees hoping it lowers your rate, only to find out the algorithm didn't care about the trees. It cared about the slope of the hill behind your house.
And the state took this a step further, right? It's not just about seeing the school. The DOI introduced Draft Regulation 5128.
Yeah, this regulation mandates that insurers publicly list the exact property-specific and community-level mitigation actions you can take.
Like a checklist.
Exactly. They have to provide a roadmap telling you, if you do X, Y, and Z, you will earn a premium discount, an incentive, or a rate adjustment.
Okay, let me play devil's advocate here. I finally get this plain language notice in the mail. I look at my score, and it says I'm extreme high risk. But I know the model is wrong.
It happens.
Like, what if the satellite image from 3 years ago thinks I have a highly flammable wood shake roof, but I spent 30 grand last summer ripping it off and replacing it with a metal one?
That scenario is the entire reason this legislation is so revolutionary. Before this, if the computer said you had a wood roof, you were priced as having a wood roof and you had almost no recourse.
None at all.
Very little. But this law gives you a formal, transparent mechanism to appeal and correct the data used in your underwriting.
Wait, so I have this legal right to appeal. Say I replaced my roof or I cleared the brush. Do I just call my insurance agent on a Tuesday and say, hey, look at my new roof, please lower my rate?
Absolutely not. And this is the most critical hurdle homeowners need to understand. Knowing your score is empowering, but to win an appeal and actually force the algorithm to recalculate your risk, you need indisputable scientific proof. Simply doing the physical labor of clearing defensible space is no longer enough.
You have to prove it to the computer.
You have to treat this like building a legal defense file. Information from the insurance providers makes it very clear they require a rigorous documentation package.
What does that package actually look like in practice?
We're talking before and after photos that are GPS tagged and timestamped.
Wow, GPS tagged.
Yeah. You need a formal pretreatment assessment report from a qualified mitigation specialist. You need contractor invoices that detail exactly what materials were used and prove that the work aligns with science-based standards.
Science-based standards. One of the standards mentioned in the sources is the IBHS Wildfire Prepared Home designation. They call it the gold standard. But what physically is that? It sounds like just another certificate.
No, it's a highly specific set of physical modifications designed to defeat the actual mechanics of a wildfire.
Mechanics like what?
Well, when a home burns in a wildfire, it's rarely because a wall of flame swept over it. It's usually because of what's called ember cast. High winds blow burning embers miles ahead of the actual fire front.
Oh, like thousands of tiny matches raining down on your neighborhood.
Exactly. They land in your gutters, they blow into your attic vents. The IBHS standard requires physical interventions to stop that.
Okay, like what kind of interventions?
It means installing 18-inch metal mesh over all your attic vents so embers physically cannot pass through. It means creating a 5-foot non-combustible zone immediately around the perimeter of the foundation.
So no mulch?
No mulch, no wood planters, just gravel or dirt. If you provide documentation that your home meets this exact physical standard, the insurer has to recognize it.
And having that documentation is especially vital for people who are forced onto the Colorado Fair Plan, right?
The Fair Plan is the safety net, yes, but it's a net you want to climb out of as quickly as possible. It is the state's insurer of last resort.
Right.
If you receive 3 or more declinations from private market carriers, meaning 3 separate companies refuse to insure you, you end up on the FAIR plan.
And we should be brutally clear about what the FAIR plan is. It is highly expensive, and it only offers what is called actual cash value coverage. It does not offer replacement cost coverage.
Right.
What is the mechanical difference between those two when a house burns down?
It is a massive financial downgrade. Let's say a fire destroys your home, and you had a roof that was 15 years old and a kitchen from 2005.
Oh.
Replacement cost coverage means the insurance company pays whatever it costs in today's dollars to build a brand new roof and a brand new kitchen.
Sounds good.
But actual cash value means they calculate the depreciation. They look at your 15-year-old roof, decide it only had 5 years of life left, and write you a check for what those used shingles were technically worth the moment before the fire.
Which is practically nothing compared to the cost of a modern contractor building a new one today.
Yeah.
You'd be hundreds of thousands of dollars short.
Exactly, which is why the mitigation documentation is so crucial. It's not just about getting a 10% discount on a standard policy.
Right.
If you are on the FAIR plan, a fully documented mitigation package gives you the legal lever to appeal your risk score, lower your threat profile, and potentially look attractive enough to bring a private carrier back to the table.
It's like fighting a speeding ticket. You can't just walk into traffic court, look the judge in the eye, and promise you weren't speeding. You need the dash cam footage. You need the telemetrics.
That's exactly it.
And I should note for everyone listening, while the current rules dictate exactly how these notices and appeals are formatted right now, there are pending rule updates that could make one minor change to the administrative process of how the paperwork flows. But your core legal right to appeal the data remains completely intact.
Yeah, the administrative process might tweak slightly, but the requirement for indisputable proof will only get stricter.
But honestly, when you lay out all the steps, hiring assessors, taking GPS-tagged photos, keeping meticulously itemized invoices, is it really worth going through all this bureaucratic red tape just for a chance at a discount?
You have to stop thinking about this as a discount program. This is about insurability. Without this documentation, if you live in a high-risk geographic area, you might not be offered coverage at any price.
And if a property is uninsurable?
A buyer cannot secure a mortgage on an uninsurable property. If they can't get a mortgage, they can't buy your house.
Wow.
Your property becomes essentially unsellable to anyone except an all-cash buyer. The red tape, the 18-inch mesh, the GPS photos, that is not the cost of a discount. That is the cost of preserving the equity in your home.
That is a terrifying, but totally necessary perspective.
Okay, we focused heavily on wildfire mitigation because that's where the most intense homeowner labor is required.
But we established earlier that hail is actually the #1 cost driver in the state. So as we look ahead to what is on tap for 2027, the state has a totally new plan to tackle the hail crisis.
They do. The state recognizes that you can't just mandate paperwork. You actually have to change the physical resilience of the buildings. That's where Senate Bill 26-155 comes in.
Right. The Colorado General Assembly passed SB 26-155, which creates a brand new program within the Division of Insurance called the Strengthening Colorado Homes Enterprise. How does this program actually work mechanically?
It is a massive grant program designed to fund structural retrofits.
Yeah.
It is funded by a 0.5% fee on the insurance companies themselves.
Okay.
And the legislation explicitly dictates that the insurers cannot pass this specific fee onto you as a line item surcharge on your insurance bill.
That's good to hear. And where does that money go?
At least 85% of those accumulated funds will be given directly to homeowners as grants to retrofit their roofs against hail and severe windstorms.
Oh, wow.
But they can't just put any roof on. They have to utilize proven, resilient building standards, specifically the fortified certification.
We hear fortified thrown around a lot, but a roof is a roof, right? It's plywood, paper, shingles, and nails. What makes a fortified roof mechanically different from a standard roof?
It actually changes the fundamental engineering of how a home withstands aerodynamic uplift.
Aerodynamic uplift.
Yeah. When high winds from a severe storm hit a house, they flow over the top and create a vacuum effect on the leeward side of the roof.
Yeah.
It literally tries to pull the plywood decking right off the trusses.
Like an airplane wing generating lift.
Precisely like an airplane wing. In a standard roof, builders use smooth nails to hold the plywood down. Under extreme uplift pressure, those smooth nails can just slide right out of the wood.
So what does fortified do instead?
A fortified standard requires the use of ring shank nails. These are nails with deep grooves cut into the metal that lock into the wood fibers, effectively doubling the uplift resistance.
That makes total sense. And it goes beyond just the nails, right?
Yep. The standard also requires sealing the roof deck. They use a specialized waterproof tape over every single seam between the plywood boards.
Okay, why'd I say it?
So even if massive hail or 100-mile-per-hour winds rip every single shingle off your house, the sealed deck prevents water from pouring into your attic and destroying the interior of the home.
Okay, so as this strengthened Colorado Homes enterprise fully rolls out for 2027, the entire goal is to shift Colorado from a reactive state, where we just passively wait for a hailstorm and then pay $1 billion to replace thousands of broken roofs, to a proactive state, where we actually build aerodynamic sealed roofs that don't break in the first place.
Exactly. It's an investment in the physical infrastructure of the state's housing stock.
Now, I have to push back on the funding mechanism a bit here.
Sure.
The law explicitly says insurers can't add this 0.5% fee as a line item surcharge on my bill, but come on, insurance companies are massive financial institutions.
They are.
Are they really just going to absorb that fee out of the goodness of their hearts? Won't they just quietly bake it into my base premium when they calculate my rate?
Well, from an economic standpoint, costs are always absorbed somewhere in the system.
Yeah.
It is highly probable that the fee puts slight upward pressure on base rates.
Right.
But you have to look at the long-term mathematical timeline.
How does the long-term math offset the fee?
Think about the return on investment. If this grant program successfully installs these taped, ring-shank, nailed, certified roofs on tens of thousands of homes across the Front Range over the next 5 to 10 years, the vulnerability of the region plummets.
Okay, I'm following.
When the next massive hailstorm rolls through Denver, instead of replacing 10,000 roofs, the insurers might only have to replace 2,000.
So that's a massive drop in multi-million-dollar claims.
That reduction in catastrophic, clustered loss is what ultimately stabilizes the entire insurance market. So even if the 0.5% fee is subtly absorbed into base premiums initially, the massive systemic reduction in claims benefits everyone's rates in the long run. It stops the bleeding.
We've covered a tremendous amount of ground in this discussion of the source material today. The reality is Colorado's property insurance market has been fundamentally restructured by inflation, severe weather, and hyper-local risk algorithms.
It really has.
The days of splitting the dinner check are over, but the state is actively fighting back. We have unprecedented transparency laws with HB 251182 finally pulling back the curtain on how your risk score is calculated and giving you a legal mechanism to appeal it.
Yeah.
And looking toward 2027, we have proactive mitigation grants coming with SB 26155 to physically harden our homes against hail.
The transition is painful, but the central theme here is empowerment. For the first time, homeowners have access to their own data, they know the specific rules of engagement, and they have the legal right to advocate for the insurability of their property.
You just have to be willing to do the physical work and, far more importantly, document the work to a scientific standard.
Exactly. Documentation is everything.
But as we wrap up, I want to leave you with a final thought to mull over. We've talked extensively about how these risk models have become hyperlocal, zooming in on the specific slope of your yard or the type of vents on your roof.
Right.
As technology continues to accelerate with low-orbit satellites, continuous drone mapping, and AI image analysis, could we soon see a future where your insurance premium isn't just calculated once a year at renewal? Could it be updated in real time?
Oh, wow. It introduces an incredible tension between data privacy and direct financial incentive.
Right. Imagine this scenario. You spend your Saturday doing a major landscaping project. You clear out a massive patch of dry, dead brush from the side of your house and replace it with decorative gravel.
Okay.
By Monday morning, an automated satellite pass registers the change in vegetation density. The AI instantly updates your risk profile, and an automatic premium reduction hits your inbox before you've even had your morning coffee.
Okay. That would turn every single weekend yard chore into a direct, real-time financial negotiation with your insurance company.
The black box isn't just open. It might soon be watching how well you maintain your yard. Think about that the next time you go out to pull weeds. Thanks for joining us in this discussion, and we'll catch you next time.